The U.S. tax code allows a small business corporation to designate up to $1 million of stock that it issues as Section 1244 stock. And here's why this matters. Normally, when you buy stock in a corporation, let's say you pay $25 for a share of stock, and then you were to sell that share of stock for $15, you would have a $10 capital loss. And there are restrictions on your ability to take a tax deduction for capital losses. I'll talk about that in another video. So what you really want, ideally, is an ordinary loss. And when the stock that you receive is designated as Section 1244 stock, so if you're the investor and you invest in a small business and you get Section 1244 stock, if you were to have a loss, let's say you sell the stock or the stock becomes worthless, then you could take up to $50,000 or $100,000 if you're married filing joint as an ordinary loss instead of a capital loss. This is a nice feature. It's designed to encourage investment in small businesses. There's a lot more to it, so let me give you a little bit more of the rules so you understand how Section 1244 stock works. So what is a small business corporation? Okay, so a small business corporation is something that when the company is formed, so it's receiving less than $1 million in money or other property. Okay, so if you start a small business and it receives $25 million right off the bat, it's not going to qualify as a small business corporation. Also, there's a gross receipts test. Basically, more than half of the revenue of this small business corporation has to come from non-passive sources. So if you have a corporation that is receiving like 80% of its revenue from royalties or interest or dividends, passive sources of income, then it's not going to qualify to be able to be for this to be Section 1244 stock. And it also has to be a domestic corporation in the United States. Now, in terms of the qualifications of shareholders, it could be individuals or partnerships. So like an estate or trust, like those don't qualify. So individuals and partnerships, and you have to be the original issuee. So basically, let's say that we give Section 1244 stock to Susie, okay, and then Susie at some point sells the stock to Michael. And then when Michael is holding the company goes bankrupt. And then Michael says, oh, I've got a loss here. Can I take an ordinary loss instead of capital loss? No, because the stock was not originally issued to Michael. It was originally issued to Susie, and Susie decided to get rid of it. So basically, you have to be an original holder of the stock to get the Section 1244 treatment. Now, it can apply to common or preferred stocks, so it's not just common shares. Now, but the shareholder, for it to be Section 1244 stock, they have to have contributed money or other property. They can't have contributed stock. Okay, so that won't. If you contributed stock in order to get the section or the stock from this small business corporation, it's not going to count as Section 1244. And it doesn't work if you contributed services in order to get the stock from the small business corporation. So if you contributed stock or services, you're not going to get to designate this as Section 1244 stock. Now, there are some limitations on the loss. I already mentioned that max you're going to get is a $50,000 that you can treat as ordinary loss instead of capital. And again, if you're an individual taxpayer but you're married filing joint, then it could be $100,000. But there's another limitation, and that is if when you originally got the stock from the small business corporation, if the property that you contributed was lost property, and when I say it had a built-in loss, then you're basically the amount that you can treat as ordinary per Section 1244 is going to be limited. So let me give you an example. So let's say you contributed some property that had an adjusted basis of $25,000 and a fair market value of just $10,000 in order to get that stock from the small business corporation. Okay, so this Section 1244 stock. So we've got a built-in loss here of $15,000 because the basis was $25,000 and the fair market value was just $10,000. So if the stock, hypothetically, let's say, so now you've got this stock and then it becomes worthless. Okay, it becomes worthless, and you say, oh, okay, well, hey, I'm glad that it was designated as Section 1244 stock. Well, here's where the limitation comes in. That amount of the built-in loss, which was $15,000, just the difference between the 25 and the 10, that is going to reduce. Like normally, you'd say, "Oh, well, I have a $25,000 loss here, right? Because I took the carryover basis in the stock of $25,000. That's what I contributed." So you normally think, "Oh, well, I'm going to get a $25,000 loss," and you are. going to get a $25,000 loss, but only $10,000 of it will count as ordinary. Okay, so even though it was Section 1244 stock, you can't count the whole $25,000 as ordinary as it's reduced by the amount of that built-in loss. That doesn't mean that you only get 10,000 in losses. It just means you only get 10,000 in ordinary losses. So the remaining 15,000, because you had $25,000 basis here in the stock now that you received, the remaining 15,000 is treated as a capital loss.